Hey guys, welcome back to Invested. And we're taking a question from one of our subscribers who left a comment. I think it's a great question. It's general, but it's a very complex question if you really think about it. So I thought I kind of addressed that. This individual wanted to say, would love to know more about information regarding picking and choosing areas. And I think this individual choosing areas is probably talking about submarkets, where to invest. So let me kind of just start with the framework of every submarket's different, right? So as an example, if you're looking in Arcadia, Pasadena, California, right? I mean, if no one knows where that is, that's a suburb of Los Angeles. You're going to have all different asset classes in those areas, similar to anywhere you go in Miami, Florida, or even Bear Creek, Michigan. So these are all different areas, but why would you select certain areas over other? And what areas makes the most sense for you? And it's very interesting because there's a lot of multiple factor that goes into selecting an area. Just because you're going to Bear Creek, Michigan, that doesn't mean it's a bad area. If you go to Miami, that doesn't mean it's a good area. Just we go to parts of Houston or you go to Lubbock, Texas, that doesn't mean it's a bad area. It's what fits within your investment parameters and risk profile is number one. So if you have retail in Pasadena, California, and you have a Starbucks, right? If you have a Starbucks similar size in Bear Creek, Michigan, or Miami, they're the same. Of course, your rental rates might be slightly different and things of that nature, but you're going to have a very different cap rates. But then, Charles, if you have a Starbucks corporate, and you have a Starbucks corporate in Bear Creek, in Pasadena, California, or Los Angeles, California, why is the cap rate so different? So then I get more money in Bear Creek, Michigan, so I should invest there versus LA, right? And that makes perfect sense. Why would I pay more money for the same asset class that generates more cash flow? But a lot of people don't really factor in risk, absorption period, the risk reward of downtimes, a lot of different things that a lot of analysts realize. But, investing for the first time, those are going to be really daunting information to look for. And how do you derive to that? So I'll give it to you in before I go into site survey in a little bit more details and submarket, how you select them. Let me kind of give you that information on the Bear Creek, Michigan, and Los Angeles, California. If someone lives in Bear Creek, Michigan, I'm not making fun of you, nothing like that. Just very vastly different submarkets using the same asset class. So if the Starbucks there is trading at a 7 cap, and let's assume the rents are the same as Los Angeles, the Los Angeles one's going to trade at a 4 cap. So using the same number, you're going to be paying significantly higher investment to acquire a Starbucks in Los Angeles versus Bear Creek, Michigan. And there's fundamental reasons why they do that. And when you ask about cap rate, a lot of brokers will talk about, it's so much more expensive in California. They're crazy out there. That's not true. We're not that crazy. We'll explain to you why we're not crazy. So if you really look at a Starbucks in Los Angeles in a very dense population with 16 million people versus, let's say, Bear Creek, Michigan has population of 100,000. I'm just making that up and giving you a distinction. So let's say Starbucks is doing well, but somehow, let's say nothing's guaranteed. Starbucks all of a sudden goes bankrupt and they vacate all their property, which any business could happen, right? Most likely not for Starbucks anytime soon, but let's say assume that happens. Then what is your asset worth? What is the value of your asset? It's still 4 walls with the 4 walls and a roof and a drive-through, 4 walls in a drive-through. Then that's when the risk comes into play. If Starbucks left because they went bankrupt, how fast can you lease that space out? What if Dutch Bros gets really big, bigger than Starbucks, and they want to take that over because it already has a drive-through, it already has the density egress and ingress by right zoning? So then they might come in 2 months after and say, hey, Charles, I love that property. We'd like to do a 10-year deal, and this is what we're going to do. We'll be triple net. Don't worry about it. We'll come in. Okay. So then you lost only 2 months of downtime of your rent. And because you're able to replace with Dutch Bros, maybe use the broker you did it. It doesn't really matter. You're able to get your rent back up to par, right? Or similar or better than before. That has the instrumental value of safety in that asset class, in that location. So using Bear Creek, what if the Starbucks went out, but there's no replacement tenant because maybe Dutch Bros not there? Maybe Wendy already has a location. What if Raising K is on another location? Or maybe Charles Kim's Burger Shop number 2 already has 2 locations. So then what is your downtime on that location to refill the space back? Is it 12 months, 24 months, 36 months? We don't know. That's the risk you take. That's why the cap rate's going to be decompressed versus Los Angeles. That's a supply and demand absorption. There's a lot of different factors that goes into it. It's like I say, it's art and science. So it's always based on risk to reward. So that's why those areas are going to be somewhat, brokers would say, more reasonable and cheaper in your dollar stretch. That's all the reasons why they're saying that. So then segueing into submarket, and let's stay on the topic of Bear Creek, Michigan. What if the Bear Creek, Michigan, the retail assets are 7 cap, right? If you're from California or New York, or even Miami, Austin, you're like, dude, that is cheap. No, it's not cheap. Because what if just because that's Starbucks, it's a 7 cap? Well, what if you got Charles Kim's Burger Shop number 2? You might be trading at a 10 cap or 11 cap. So that doesn't make that Starbucks location cheaper because you're comparing to California. It's not apple to apple. So then you're actually paying higher cap rate and you're taking the most risk in the Bear Creek, Michigan by buying that versus buying something different that's trading at a 10 cap. But because that being Starbucks has less risk than Charles Kim's Burger Shop, that's why it's more expensive. So these are the things that you have to look at when you look at a submarket. Are you really paying the right submarket cap rates for the risk you're paying? Okay? And a lot of different areas, like I invest, even though I reside in California, I can be invested in Texas, Arizona, all over the country. And the reason why we can do that now is because we have significant amount of technology. It's purely you can live anywhere and invest anywhere. And that wasn't true back in the 70s and 80s because you had local developers, local investors, and they knew everything about that submarket. But now technology like Crexi, CoStars, Redfin, Zillow, you can look at data everywhere and be able to invest. That makes a small investor that much more powerful because you have information. So when you're selecting site, few things that you really want to look at, and we did a video on some of the analysis and overview, but kind of summarize the area is, what is the driving factor? What is the population? Has the population grown over the 10 years? Was it organic growth, or was it a catalyst where a lot of people flocked to that area? Okay? Or maybe it was not a college town, but all of a sudden there was a new university that came into place there and boost the population. So when you have a boost population, you have college, students coming in, what's going to happen? You're going to have more bars, right? I used to go to bars a lot, even though I was underage. Sorry, don't sue me. But second, you got to have more retails, right? Because now you have a bigger population that's going to be able to spend the money, right? Before, some areas that only had Dollar General, but population grew 20 times. Now you're going to have Albertson, Kroger's, even Whole Foods can go in there. If you look at Flagstaff, Arizona, the population exponentially grew in the last 10 years, even 7 years, and even further during COVID. Now you have a Whole Foods at Flagstaff, Arizona. So you have to look at population growth from organic and in-migration growth. That's going to be key. Because more population, you need more asset, people spend more money. Basic math. Second, what is the catalyst for additional growth in the future? Is Tesla moving in? If Tesla is moving in and they're building a mega factory, guess what? They're going to bring engineers. They're going to bring manufacturers. They're going to bring in administrators. They're going to be in janitor. It's going to grow that population, number one. But guess what? Tesla employees or people working there, I'm going to have to assume they get paid pretty well. So then they're going to have a better, higher spending habits. So instead of people going to shop at Macy's, now people are more inclined to shop at Nordstrom. So then Nordstrom's going to come in and Nordstrom's going to hire more people. Then more people need more profits. So those are going to be something you look at. You're going to look at population growth and you're going to look at catalyst for growth as in jobs. Third, dynamic economy of that area. Is it just service? Is it just leisure, right? Hawaii is a very leisure state, right? If people don't go and travel there and spend the money, the economy will be tiny because they don't export anything except for Dole pineapples and a few other things, right? But because people are going in there to spend the money, you have one of the largest hospitality and leisure travel around the world. So you got to look at what kind of economy he has. If he has finance, if he has education, if he has medical, if he has tech, it's going to do very well. Then you're going to select which asset class that's going to serve you the best, where you may be most comfortable. So those are the reasons why you need to look at the submarkets carefully. And even within the submarkets, there are going to be certain districts. So even though you're living in California and wanted to invest in Texas, go take a trip to the area you want to invest in. Drive around, talk to people. Go eat out to restaurants, right? Get familiar with it. Then once you do that, that's part of your due diligence. And that's going to really guide you which area within the submarket is going to do well, what asset class is lacking, or what asset class you think will do the best, okay? And I'll use one more example. Let's say there was a population that's growing and there's a shortage of houses and people are building houses. Then until those houses are built, you need to rent. So then multifamily is going to spur up, or even RV parks, because they need transitory places before their houses are built. But then if they're moving, their houses are not built, what are they going to do with their furniture, all the things, the self-storage? Those are kind of the ideas you need to get with asset classes by also looking at the areas of submarket. I hope that information was helpful. And if it wasn't clear, if you want to add further questions, please add the comments and we'll address it. If you found this content helpful, please like, subscribe, and follow us.